momentum indicators. In momentum indicators, the first thing we do is momentum. So momentum of N day basically is very simple. It's just today's price minus N day before. So how to use this simple rule? So what you do is see whether today's momentum is positive. If it has been negative for K period, K is something you decide. If negative change to positive, then you buy. If it had been positive, suddenly become negative, then you sell. So what this rule is about, not easy to understand, but suppose you use, instead of N-day momentum, use one-day momentum. The one-day momentum is today's price minus yesterday's price. Then if the price has been going down and suddenly go up, okay, then you will see past momentum will be negative because it's dropping, and now suddenly rise, then the momentum become positive. Okay, so basically it said it buy when you change from dropping to rising if you use one-day momentum. Of course, if you different day momentum, you have a different style, but this is basically what the momentum strategy suggests. Okay, so what it said is, if you look at the graph here, the momentum change to positive to negative, then you sell, and when you change from negative for positive, you buy. Okay, so in particular, if you use one-day momentum, basically what it said is the price changing from increasing to decreasing, then you sell, and when the price changes from decreasing to increasing, then you buy. Very intuitive. So the next one we are going to cover is a rather useful one. It's called Relative Strength Index, RSI. We cover two versions. One is simple, the other is exponential smooth, but they're very similar. So we understand one, understand the other. So now instead of using the price directly, we'll use the price direction. So that's why it's called relative strength. It's a strength, it's not the price directly. So we define first two things is upward and downward indicator, UT and DT. And it's very simple, although it looks complicated, the formula. So UT is upward indicator, which means that if the price of today is higher, slightly higher than yesterday one, then U will have value of 1. If it's not the case, then you're 0. So if the price go up today, UT is 1 today, and if it is not going up, then it's 0. Okay. Similarly, you can define DT, a downward indicator, as if the price of today is slightly less than yesterday, then D is value of 1. So if not the case, then it's 0. So if the price go up, U is 1 and D is 0. If price go down today, U is 0, D is 1. But if price is flat, U and D are both 0. Okay. So now based on U and D, we can divide up and down. So basically, up and down are the average value of U and D. Okay. So you look at past N day, up of N will be the N past N days U, down N with the past N day of D. So once with up and down, we can further calculate an indicator called RS, which is the ratio of up over down. So which is looking at past N days, what is a proportion of days we have go up and go down. Then basically look at how many days on proportion of days that stock market has gone up and how many days the stock have gone down. So how many days look at usually is 14 days, and it's 14, and sometimes use 31 or 35, and usually a multiple of 7. And this number, of course, higher usually means you've been go up more. Okay, but when you compare days given n, then it's not, this RS can go up and go down. So usually normalize it, because RSI is always between 0 to 100. So how you normalize is 100 times RS over 1 plus RS. So this is the thing you do. And 0 means many days are 0, 100 means every day has been gone up, and 0 every day have gone down. Okay. So what is trading signal based on RSI? Is rather different from the trending rule. So you will see the RSI will suggest if it's less than 30, then you buy, more than 70 you sell. So this is a little bit different from what might be expected, because when RSI is high, you see the stock have been gone up, right, for more, and when RSI is low, the stock have been gone down. So how to justify this particular strategy? Of course, one way to do it is say it's contrarian, okay, and the other way to do it, say it is because of people who said this is oversold and overbuy, because buy and sell are supposed to be more or less neutral, usually between around 50, right? Go up and go down should not be too much. But if RSI has been very high, more than 70, then it means that too many people buying it. It's overbought, so you should sell it. And RSI is very low. If RSI is very low, then many people looking at it, then it's time for you to buy. So it's more like a contrarian style of a trading rule. So next, we want to talk about a smooth version RSI. Actually, they're not too much different. A simple one, but instead of up and down calculate average of U and D, you use an exponential version of U and D. And that means when you calculate the smooth version of RSI, then you also do the same as we do. The first RSI, we use the average version, and subsequent one use the update formula. And the trading signal is the same. When RSI is low, then you buy. When it's high, then you sell. So basically, the graphic look like this. There's a sell threshold is 70, above it you sell, and there's a buy threshold below 30 you want to buy.